Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for tuning in, thank you for watching the channel, and thank you for the subscribers. This channel is dedicated to the rational investor, the investor looking to buy cash flow in the stock market, and that's ultimately what underpins the value of any investment. And we go out to find out what is the true cash flow of any company. We then assess what we believe the value based on that cash flow stream is, and we compare that value to the stock market's current trading value and figure out if there's an economic return that we can get over the long term as the stock market realizes the actual intrinsic value of the investment. This is not for speculators. We are buy and hold long-term value-based investors, and we use cash flow as the underpinning for all analysis. At this channel, we look for 5 key attributes for all investments as the starting point for any investment. And that would be top-line revenue growth, earnings growth as we define it by EBITDA, strong free cash flow, a good balance sheet, and a well-priced stock. The well-priced stock being the hallmark of a good investment. You have to buy it at the right price to really maximize the return. And we use a value-based earnings multiple to determine what is the right price. I don't mean the actual stock price, it's $1,000 or $100. No, the multiple of earnings is what we look for. And in this instance, we use the enterprise value divided by EBITDA metric. I'll get to that all in the deck in a second. But today we are going to look at CVS Health, the health innovation company as they describe themselves. Realistically, they're a pharmaceutical company or retail pharmacy that bought a large health insurance management company called Aetna. And what they're trying to do is they're trying to take all the members that are in Aetna, some 105 million of them, and funnel them into their pharmacy to try and cut cost in healthcare. And I have to say, I like the objective, the business model. The industry is absolutely ripe for a reorg. Everybody says that healthcare is way too expensive, and I'm glad to see a company, a CEO, a management team stepping up and turning their business around to try to address this issue. And I think if they can solve it, there are millions of customers out there. So let's dive into it. I've got some facts that I want to go through with you on CVS Health just to give you, kind of set the landscape for how big they are, what they do, if you're not familiar with them. They're number 5 on the Fortune 500 list right there. That's fantastic. Nothing like size. They reach 70% of the U.S. population in the retail stores. They wrote 2.8 billion prescriptions were filled or managed last year by these guys. They're huge. They own almost 10,000 retail stores, and I think they have access. Their pharmacy network is another 68,000 pharmacies. So they're really, really big. And if someone in this industry can do it, they're certainly already supplying the customers. There are a number of startups that are trying to fix the prescription drug market, but they're starting with 0 customers and an algorithm. These guys are starting with cash flow and a customer base and are already doing it. So I kind of like that as a foundation. Let's see what the financials bear out. Let's go through the 10K, talk about the company, and see what we think this business could be worth in 10 years and where it's trading for currently if there's a return to be made. Okay, behind me is their most recent 10K. Again, that's the annual filing that they file with the SEC. It's also called the annual report, oftentimes on the company's investor relations website. Essentially, the annual report is typically 5 or 6 pages, maybe a dozen pages of high gloss, super colorful stuff, and then basically they put in the 10K right behind it. So you can either get the annual report. This is the 10K official that I get from the SEC's website. So let's dive in. A couple things that I really liked. One, I have a great summary of their business right off the gate. They talk about what their business is, who they are, where they're going. They've got a motto that talks about there's 3 objectives that they try to accomplish. They want to be local, they want to keep it simple, and they want to improve health. Like that's their 3 key core concepts, and I like that. And it's echoed by the CEO and management team as they continue to refine the business and produce simple, effective solutions that save money. And I think that will help them win market share. But let's go through this. Business overview, which is super nice. And then right below it here, the business strategy, which what they're trying to do is take the Aetna healthcare insurance company that they bought that does insurance medical plans for 100 million people in America, and then take those members and get them to come to the pharmacies in CVS and fulfill the prescriptions that they get in their health insurance network at the retail locations. And they're hoping that by doing that, they can cut out a lot of middlemen and be a low-cost provider. They're also establishing what they call minute clinics, where they're basically small medical service providers that have nurse practitioners in there to give basic healthcare advice at a very reasonable cost and a quick turnaround. And I think that could definitely win the retail network as they continue to grow and get feedback from, I think they already have 1,100 of these already up and running as they grow those. I think that bodes well for the company. But you can read through this. One page I want to go to in particular is page 8. Page 8 here, I thought this was really interesting. When I see CVS out in the world as you're driving around, I always thought them more as a retail, like a 7-Eleven, if you will, that happens to have a pharmacy in the back. I didn't realize that 70% of their revenue is the pharmacy. So that they are effectively a pharmacy location, a retail pharmacy company that happens to also sell snacks and sodas and so forth at the front counter. But first and foremost, that is their business, and it looks like they're doubling down with that with the purchase of Aetna. Okay. Then the next thing I wanted to show you on 62, they have a very good overview of the company here. And so you can see product revenues, service revenues. They primarily sell at $185 billion. They primarily sell products, which in this case are pharmaceutical drugs. And then they have services for doctor visits and so forth that they hope to grow. But it's a good overview. It also gives the costing associated with those revenues, so you can do like a little gross margin by service sector, or by revenue segment, which I think is a plus. Okay, let's dive into the financials, and we can come back to the 10K as we need to reference it going forward. Here we are. So this is their revenue, 2011 to 2019. Fiscal year end December. So was this September 2020 when I'm doing this video. So another quarter and we'll have a full year. So there's still a little bit of there's 3 months basically of data that's not in this. But we look at everything on an annual basis, and we're long-term investors, so that's what we're going to start with. Basically $107 billion, and it grew to $255 billion, which is an annualized rate of 11% a year, which is very strong top-line revenue growth. And there's one monster caveat, is that in November of 18, that's when they closed the acquisition of Aetna for something to the tune of $70 billion. So this large step up, 26% growth in 1 year of revenue, is the growth from adding on that acquisition. If you look at it, their revenue was growing around 6, I think this average is 6.3%, was this kind of long-term average of just CVS by itself before it bought Aetna. So when you're going forward, I think you're looking at single-digit growth. This 11% is a little inflated because of the acquisition. And I've realized that I'm showing you EBITDA growth. I don't call out revenue growth, but the principle remains the same. That the revenue here over this time frame, 126 billion, 139, 153, 177, 184. I mean, that's steady growth, which is fantastic to see, but it's single digit. So I don't want to confuse the acquisition of Aetna inflating the 11% on average. But it still checks the box for us, top line revenue growth check. Let's go to our earnings metric, which is EBITDA. So EBITDA, as a reminder for the new people on the channel, EBITDA stands for earnings before interest, tax, depreciation, and amortization. And what does it mean? It is an earnings figure at the enterprise level. So forget net income for a second, which is below the line, they call it. We want to know what's above the line, what's above the operating line. So net income can often have expenses like for pension charges, currency fluctuations, shutting down of business, and so forth embedded in that number. What we're looking for is a higher number that represents the kind of run rate average of the business. What does the business do apart from the one-time issues, apart from the non-cash charges, which is an EBITDA, which is a depreciation and amortization? So we look at EBITDA. And the way we get that, I'll show you as an example on the P&L. If I take our income statement on 93 of the 10K, I can zoom in here so you can see this a little bit better. So here's the revenue, right? A revenue of 256 billion. I can come down to net income. Net income is $6.63 billion. And I'm going to start adding back to that to get to a steady state. So I'm going to add back income tax provision because that's not actually what they paid in taxes. So I add that back and I get this $9 billion figure here. And then there's the interest charge, which is the big number here, $3 billion. I'm going to add that back because when we look at the business, we want to look at it as a whole. So you put debt aside. You pretend the business has no debt for a second. If it was debt-free, what would it generate? So it would not have this interest expense. So you add that back and you get to this $12 billion number, which is about operating income. And oftentimes you'll see me talk about operating income as the starting point for EBITDA. It's essentially earnings before tax and interest, EBIT. EBIT, operating income, they're kind of the same thing. But to get EBITDA, we have to do a couple more things. We have to add in depreciation and add back amortization, which are non-cash expenses that are sitting in the P&L. And what we're looking for is kind of a proxy for cash, and so we want to take that off. So we're going to come down here to the cash flow statement, which is here, cash flow statement for 2019, and we're going to pick up the depreciation and amortization charge of $4.3 billion. So you add that to the other number, I think that was 12, you get roughly 16 billion of EBITDA, and there you go, $16 billion. So that's how you bridge that. I will also show you a couple charges that you need to be aware of. Here in 18, there was a $6 billion charge for a write-down, an asset impairment. Now, this is a non-cash charge. It's basically a purchase that they made years ago. They put on the balance sheet as having a particular asset, and then something changes in the market. And they looked at it and said, well, wait a second, that's not actually worth what we have on the balance sheet. We have to write it down. We have to take the number and just reduce it in the balance sheet. To do that, they expense it in the P&L. Now it's an accounting charge, so it's not actual cash. So in this instance, we're going to add it back to depreciation because it's not actually cash. If it happens regularly, then it's a problem with management and it's a red flag. But a one-off, everybody makes mistakes. You don't crush the business because they did it once. So I've added this back in the EBITDA, and you get the $12 billion here that I'm showing. The point here, back to the EBITDA, for all the new people, that's what EBITDA is, enterprise level earnings if there was no debt. $3 billion, or call it $8 billion to 16. Again, you got the step up here because they bought Aetna. It artificially grows the growth rate. So EBITDA grew 9% over that period of time. But realistically, as I said before, if I add in like this range here of like before the acquisition, you're at 6.3% growth. So kind of mid-single digit EBITDA growth, which is still checks the box for us. All right, that's EBITDA. We covered revenue, we covered EBITDA, both growing single digit every year, producing pretty steady results, which is great to see, especially when you're trying to forecast forward. You really want a nice level set and just don't pay too much for that cash flow. All right, now let's build up to enterprise value. So we covered the first two, right? Revenue and EBITDA. Now what we need to do is we need to look into how do we come up with the enterprise value as a whole, and is there too much debt in the business? So to do that, we're going to start with debt. $9 billion, it grew to $90 billion. That is a tenfold increase over this eight-year period of time. That is a monster increase in debt. What happened? Well, you can see it's pretty level set here. 10, call this 10 to 25 billion. All right, that's 2.5 times over that like 6 years. That's okay. Certainly because EBITDA is growing, they can afford to pay it, no big deal. Here is the payment at Aetna. So Aetna was $70 billion. Some of it was cash, some of it was stock, and they also borrowed. They borrowed to get the cash. So the cash was borrowed and then they gave stock. And you can see the step up, right? If Aetna was 70 billion, they went from 25 to 90. That's about, 55 billion of extra debt that came from as a result of the acquisition. So that's why they're higher in debt. Cash on hand, they have a little bit of cash on hand, but really nothing too significant. Market cap is shares outstanding times average sale price. It's gone from 50 to 96 billion. It moved up, but not nearly as much as we would like to see given that acquisition. Enterprise value. So enterprise value is debt less excess cash plus market cap. It is what the entire business is worth if you were to try to buy it lock, stock, and barrel. If you think of like a local pizza shop that you wanted to go buy a Papa John's franchise or some sort of ice cream shop at your corner, you'd buy it from that guy, from the entrepreneur, for let's say $100,000. That would be a debt-free business. You would then, if you didn't have the full 100, you'd go to the bank and say, hey, can I have 50? And then you'd say, okay, here, sir, here's your 100 grand for the business. This is mine. I now have 50 from the debt, 50 for that I put in cash, and it's levered 50-50. But when you bought it, when you transacted to buy originally, you bought it for no debt. And that's what we're doing here. We just want to see what is the business as a whole worth, and then we can lay on there a capital structure afterwards, which is the correct way to do it. So use your enterprise value. Now let's look at debt, okay? Debt has gone, as a result of the acquisition, right? Debt has gone from basically 1.5 times to 2 times EBITDA. And I'm just taking this column debt, dividing it by this column EBITDA. 1.5 to 2 times EBITDA, which is low debt, and we like that. It's gone up to 5.5 and 6 times debt, which is too high for us. We like to see less than 3 times debt. That's what we're targeting for an appropriate investment. Okay, so they're highly levered, and that's not a checkbox we can tick. It's going to be one that we have to be careful about and see how they're managing that. Then the next thing is multiple. So you've got, right, on our 5 characteristics, we said revenue, that's growing, check. EBITDA, that's growing, check. Debt is too high for us. I can't check that box. Price, we use a multiple of earnings right now. And so you can see this enterprise value to EBITDA range, low end 7.5, high end 13 times is the average. Currently it's trading at 10 times. So it's actually below its peak. And it's fairly reasonable for a business of this size with kind of the stickiness, which is a prescription business. 10x is not an unreasonable measure by any means. It's not cheap. It's not the 7 times that it was before, which is dirt cheap, but it's not expensive. 10 times is a very reasonable multiple to pay for this. So I think this checks the box as far as pricing goes. It's a very reasonable rate to get in on the business. Okay, so what do we cover? Revenue, check. EBITDA, check. Debt, not so good. Pricing is fine. Let's go take a look at cash flow. Okay. Cash flow. My favorite statement, where the rubber meets the road. 2011 to 2019, cash flow from operations. CFO is the first third of the cash flow statement. So if I go to their cash flow statement, and I back out so you can see the whole thing. Here you go. First third, right there. That's cash flow from operations. you'll see it, cash flow provided from operating activity. It always says this line, by the way. So in pretty much every 10K I've ever read, this line here, net cash provided from operations, that's the line. It's always called that, and it's nice that it says that. Pick that one up. The next one we're going to look at is CapEx. So, well, let me cover free cash flow. So free cash flow, $5.8 billion to $12.8 billion. That's a growth rate of 10% a year, albeit this year here was the step up between Aetna and the new. So this bump is artificially high, but you can see 5.8 to 8 billion, decent single-digit growth. This cash flow from operations is also growing in line with EBITDA on the P&L. You have different financial statements, right? The income statement, which can be massaged by management depending upon how they want to frame the business. They've got lots of discretion there. But the cash statement can't. Cash is hard money, cash in the bank. You cannot make that up. So if the two statements are jiving, that tells you management is being honest with the representation of the P&L, which is critical. If that's what you're relying on, if you're relying on net income as your like price per your PE ratio, right? If management's distorting the income statement, then they're effectively lying to you, and you're buying something you think is one, but really it's something else. So you got to smell check that. And the way you smell check is CFO. CFO and EBITDA line up and go together like this. 10% growth long term, 11% growth long term. Even though the Aetna thing, it's still in line. That's a checkbox. Good job on the accounting side. All right, CapEx. CapEx is what they have to put back in the business, what they use to build new store locations to grow, what they have to pay to close old store locations, new enterprise software they have to install to run their systems. That is the ongoing cash they have to reinvest in the business to maintain what they have. It is not the acquisition of a new enterprise. It is not going into a new a business line. That's completely separate. This is just maintain what you got and be able to continue to produce that cash flow. That's this number. And where I get that number, you can't, this is way too small. You can't see that. I'm sorry. So back to the cash flow from operations, because you can't see cash flow provided by operating activity. That's what I picked up. Here's your 12.8. Now, if we come down, you see this 2.45. That line is the purchase of property, plant, and equipment. This is what you want when you're talking CapEx. Read the definition: purchase of property and equipment. Should say plant and equipment, but I guess they don't have a plant. So that is what it takes to continue to grow the retail location. If you have that in the cash flow, that means they can continue to grow their locations like they have been in the past. So what do we do with these numbers? Well, you net the two. You take cash flow from operations minus cash, and you get free cash flow, right? Free cash flow to the company. There's one more piece that we want to provide, and I'll get there in a second, but I want to examine this. What we look for at this channel is a strong delta between the cash flow from operations and the CapEx. Basically this difference. If I take 8.8 here minus the 2, I get 6.8. That is the cash flow that's available for shareholders. 8 in the next year, 8 minus 2, again, 6. 10 minus 2, 8. These are healthy numbers. It means every single year they are generating positive cash flow like clockwork. And you got to see that. You can't forecast. If that's all over the place, it's positive, negative. It's very hard to forecast, and that means it's higher risk. And what we're buying is a steady stream of cash flow, and you want to get it at a cheap price. Those are the two things that you really need. So what I like here is checking that box. The next, we want to look at the debt payment, because debt has been growing. What's going on? Well, when I look at this here, these are all negative. It means they're paying down debt. If they were positive, they'd be borrowing debt. So what have I done? I've made two critical adjustments. Basically, they bought two companies, one in 15 and then the Aetna one in 18, and I have removed that debt as the cash flow because it's not available for distribution, right? You couldn't, they use the cash to go buy Aetna. So I don't want to put 70, I think it was 40 billion. I don't want to put $40 billion here because it will distort the rest of this. So all I've done is I'm including just the debt they would normally borrow, kind of an ongoing operations, and their debt payment that they make. And I'll show you that. So back to our cash flow statement, right? We've got Top third, cash flow from operations. Middle third, cash flow from investing. And what you want here is a property, plant, and equipment we covered. Bottom third is financing charges. Financing charges, that's debt. Debt, share buyback, dividend, all that stuff is down here in the bottom third. And I'm going to zoom in so you can see it. Hopefully you can see this. Cash flow from financing activities, the net repayment of short-term debt, proceeds from issuance of long-term debt. It's right there in black and white. Proceeds from issuance long-term debt is what we really want. And then the repayment of long-term debt. It's that simple. And then what you do is you look over on the side and you see the payment. They made an $8 billion payment down on their debt. That's the mortgage payment, whatever. And then they borrowed an extra 3.7. That's new debt coming in. And they may have been, rolling some debt because something matured and they wanted to reborrow. That's okay. They have plenty of cash flow to be able to do that. They're not manufacturing cash flow by borrowing. This is kind of the natural ebb and flow of the debt. So all I'm doing is just netting these two numbers, 8.3 and 3.7, and I get 4.6 negative. So this is essentially the average or the net cash out that they have to pay. So long story long rather, the sum of this is our free cash flow to equity. This is what we're buying. When you buy a company, you're buying this column. If you put it on a per share basis, you're buying this column. But either way, this is the underlying value of the business. It's how much cash it kicks out. And A, you'll notice it's positive. B, you'll notice it's growing, kind of. Depends on some of the debt payments. Certainly in here, they've made massive debt payment. So it's limited near term post this acquisition. They're trying to buy down the debt. So what you'll see is it's 3.3, 4, 7, 4, 3.2, 5, 6. It's a decent chunky number. Here it gets a little low, 1.3, 5.7, mainly because these big debt payments, right? 5.5 billion, 4.6 billion. If they pay that down, that goes away, this cash flow spikes back up and you'll see a pop in the share price commensurate with that. But let's finish this table. Shares outstanding have largely been flat with zero annualized growth. They're not really buying back shares. Certainly, well, they were, but since the acquisition, they had to issue shares to do it. So you're kind of net on the same over the long term. Cash flow per share, 6 on the high end, 1 on the low end. 4.5 is kind of what I'm pegging as an average run rate because they're making a healthy down payment on the debt that they used to acquire Aetna, and they still have some cash because they do pay us a sizable dividend. That dividend is coming from this cash flow, and I'll show you where that is. So if we go back to the cash flow from financing activity, scroll down, dividends paid, right there, $2.6 billion in 19. If I come back to our cash flow, right, we said cash flow from shareholders, 5.8 billion. Okay, 2.6 of this 5.7 was actually paid out to investors as a dividend. The rest was retained as retained earnings to help the business grow above and beyond what they expense in the CapEx. You with me? This 5.7 they can choose to give out or they can choose to retain. Let's keep going. We're getting long, and I apologize for that. So the net result after the end of the day, the shares are $74 in this end of fiscal year. This cash flow, $4.45 per share, gives me a 6% free cash flow yield at the end of the fiscal year, which is a very attractive yield. On average, if I look at all of this, you've got a 6% average yield, which is what the business tends to yield over the time, and it's been positive the entire time. Excellent. Okay, now what? Let's review. 5, top line revenue growth, yes. EBITDA growth, yes. They have too much debt, check. Well priced, it is reasonably priced, if not borderline inexpensive, given the 10x multiple. And then strong free cash flow, I give it a yes. At 6% yield, it's a strong cash in this market. All right, let's see what's next. Let's go forward and forecast. What I want to do is I want to talk about this debt for a second. So we know the business has historically been less than 3 times debt. They're at 5.5 now, and they're trying to get to pay that down. So if you buy the stock now, you're going to have to weather a few years of less cash flow while they pay down the debt. But we want to know, how long is that going to take? Well, that's what I did over here. So I'm saying if I said that they need on average 3 times debt to EBITDA, if I take EBITDA times 3, that's total debt. I then compare it to what they have in the market right now on debt, which is $90 billion. I can get a pay down. I'll give you an example. So I said current EBITDA, $16 billion times 3 means that they should have $48 billion of debt, $48 billion, but they have $90 billion. So they need to pay down $40 billion of debt to get back to our leverage. And they're going to do that over time. And what I wanted to know is, at what point have they paid it off? Because then that cash that they're paying the debt can be sent to the shareholder, and the shares should go up. So what I'm doing here is I'm basically saying this is the incremental debt payment that we saw, the minus $4.8 billion that they're paying down. And they're going to make it every single year. This is a cumulative pay down schedule. So 4.6, 4.6, 4.6. That's what's going on here. I'll just show you this minus this, 4.6. Right? So it's a fixed number. This is just cumulatively how much they would have paid down from where they are now at 90. Now, this is my EBITDA forecast. So if I know my EBITDA forecast as they grow, and I know they want 3 times debt on that EBITDA, and that's my assumption. They actually have had less historically, but I want to just give them a 3 times because they'll probably have more than they used to. In order to get there, that means if I take 16 billion of the forecast times 3 minus the pay down that they made last year, less than 90, that means I have $34 billion left to pay down. The next year, after having made yet another payment and grown EBITDA a little bit, so I can have a little bit more debt on the balance sheet, I now have 27 left to pay down, then 20, 13, and I break even at 2025. So they've borrowed enough money. It's going to take them 5 years to pay this down. But when they do, that $4.6 billion that they're currently paying down is a lot of free cash flow that's going to come to the shareholders. And I'm going to say, just for fun, that we get half of it. We're not going to take all of it. I'll say half. But we'll get there in a second. Let's finish the EBITDA forecast. I'll give you, and then I'll show you how this turns into cash flow. EBITDA forecast. This is getting all over the place. I'm sorry. There's a lot going on. Try to follow. Just hope you're following along. EBITDA forecast. I'm doing 4% growth off of last year. So they were growing at 9. We know that's too high. We know that they're growing in here. That's about 6.5. I'm calling it 4% to be conservative. So I'm going to say you're going to take this $16 billion and you're going to grow it at 4% annually for the decade. 4% annually gives me $24 billion. I'm going to assign a 10 times market multiple to that. On average, they have been at 10 times. They're currently trading at 10 times, so no market multiple expansion. That puts them at $240 billion of market cap, less debt at the time in the future when they have 3 times debt, 3 times 2467. That's how much debt. So less the debt plus cash. They have very little cash. Gives me a market value of $173 billion. Less the 1.3 billion of outstanding shares gives me a price target of $133 per share 10 years from now. Okay, that is one of 2 methods that we're going to use to estimate price target. That's called the EBITDA market multiple method. It's a standard thing used in investment banking and private equity. It's ubiquitous. Look it up. But EBITDA market multiple, that's how we're going to do it. Gives me a $133 price target. Now, let's do the cash flow. And I'm going to remember my break-even thing when we pay off the debt is 2025 cash flow. So we said that last year they made $4.45 cash flow, and that's because they made a big payment here of $4.6 billion. I'm going to grow that at the same growth rate that I have EBITDA, 4%. But in 2025, when I have paid off all that debt, that $4.6 billion, I don't have to pay down debt anymore. I can send that to the shareholders, or I can go buy other companies. I can do other stuff with it. But we're just going to assume it's distributed. That is $3.54. That's 4 cents. That's taking 4.6 billion divided by shares outstanding, $3.54. I'm going to say I get half that just to be conservative. I get an extra $1.77 bump in the natural earnings of the company. And you can see that right here. I go from $5.42, which is my 4% growth. Add it, I get $7.40, and I grow that at 4%. And what I get is a $173 valuation. That is this $8.66. I think I gave it a 5% yield. So if I come back here, it's yielding 6% right now. I think that's in this range. It has been 5. We've looked at lots of stuff on this channel that's 5. So I'm saying 5% is the yield that I'll give it on a cash flow basis, and that gives me a $173 price target. Okay, now we have 2 price estimates. We have a cash flow base and we have an EBITDA market multiple. Let's take a look at the 2 of them. Current stock price is $59, roughly, here. I've got 2 methods, cash flow based, $167, which is actually above the EBITDA market multiple of 133. That market multiple of 10x is probably a little soft. Maybe it could get 11 or 12 times, but I stuck with the 10. I averaged the 2, I get $153. Future stock price, again, 10 years from now. I don't know when they're going to achieve it, but I just throw it out there for 10 years. What happens if we put this in an IRR calculator? You buy the stock this year for $59. It generates cash flow, which you don't get all of it, right? You get some of it, they reinvest some for extra growth, but that's on top of the CapEx that they naturally would already have. We've already expensed it. So you get this stream of cash flow, which we're assuming they just pay it out. That's why we're not growing all that high. We're growing 4%. And then at the end, you get your $153 back. This stream of cash flow, if I put an IRR on it, is a 20% annualized IRR over that decade, which is an outstanding return for this market. And over that 10 years, you'll make 3.7 times, almost 4 times your money over that decade period of time, which is a super strong return in this environment. So I think this turnaround that they're going through, the consolidation of the acquisition has gummed up both the story for them as investors, because it's a big acquisition they're trying to digest. It's taken cash flow away from investors, so I think the share price has been hurt. But if you have a long time horizon, you want to be in the healthcare space, and you believe that they're able to accomplish the consolidation of what they're trying to do, then this is an excellent investment that over time will grow as the 2 companies integrate more. It seems like a really good deal. This channel, we're going to give it a good. We think that it embodies the principles that we need, with the caveat that the debt needs to be paid down. And it looks like they're doing that. And so I'm gonna give it a pass, even though it is 5x and we say no more than 3. The other 4 characteristics being top line revenue growth, earnings growth, free cash flow, and a well-priced stock, all of those seem to have priced in the debt, and I like it. I certainly like the predictability of cash. Everything we've seen here has been growing and positive, which is nice to see. Even if that growth isn't double digit, it's still nice to see it's going the same direction every year. So I think I'm going to give it a thumbs up, give it the good rating. It's a 20% IRR possible target. Don't call me in a year and say it hasn't moved. It's going to take them at least 4 or 5 years to pay off the debt. But the stock price should rise as that debt is paid down. Let's give it a benchmark here. I think that's 40. That's right. Yeah, so let's see if this works. Oops. Wrong one. Sorry. Give me 1 second. There you go. So this is our IRR distribution matrix. So here's the $59 stock price. As the stock goes up to $79, the IRR comes down. Still a 15% IRR if it continues to hold. This long-term forecast stays. If the price should fall down into the near 40s, you're looking at 26, 24% IRR, assuming the same long-term price. So I think this allows a lot of good upside. It meets some of our criteria, and it's cash flow based, which is what we look for. Okay, thank you very much for the time for viewing CVS Health, the review. I really appreciate it. Please subscribe if you like the channel. Comment, let me know what you think, and if there's anybody has any other information on CVS, on how that consolidation is going, let us know. Always interested here. Non-public information. No non-public information, please. Only in the channel, open-sourced information. But any comments are always welcome as far as how the consolidation is going. Let me know what you think, and hit the subscribe button. My name is Cameron Stewart. This is Rational Investing. Thank you very much. Bye-bye.